Treasury yields are exploding higher. There is something big happening right now in global markets that includes currencies such as the dollar. And unfortunately, I think this ends in a doom loop of inflation and deflation at the exact same time. I'll explain that at the end of this video. But I'm going to reveal everything to you, everything you need to know in 3 simple, fast steps. Step number 1, let's go over how right now these central planners are completely losing control. We start by looking at a chart of the 10-year Treasury yield. Now, we're not going back 20 years, not 10 years, but only a few days. Now, I want to highlight what happened July 1st with the 10-year Treasury yield. This chart starts right around 8 a.m. We're not too exact on the times, but this gives you the general idea of what happened. Go to about midday. On the left, we go from 4.39% up to 4.48%, around 10 basis points difference, which for the 10-year Treasury yield is really, really a big delta. So we start kind of just churning between 4.39% and call it 4.42%. Kind of what you would expect with a daily range. But then we get to this point and it just skyrockets all the way up to over 4.45%. It takes a breather and then it goes parabolic over 4.48%. A massive move in a very short time with the 10-year Treasury yields. But where this gets very interesting, or maybe bizarre would be a better word, is if you compare this exact chart with a chart of the dollar yen. During the exact same times, exact same day. Editor, go ahead and throw up a chart, and we see that it's almost identical. So as the 10-year Treasury yield is spiking higher, the yen is collapsing against the dollar. And this 160 mark with the yen to the dollar is very important because this is the line in the sand that the Japanese central planners have tried to defend. We go back just a couple months and the Ministry of Finance intervened in the market by taking $60 billion and selling them into the global FX market to buy back yen. This was to defend the currency. So say we were right around 159. When they did that, it dropped all the way down close to 150. But since that time, as you would probably guess, market forces took over and the yen has steadily been losing value, meaning the amount of yen gets higher and higher and higher that you need to buy $1. So when I'm saying losing in value, that's why my hand is going up. Just FYI. To the point where now we've broken through this 160 mark, and following the 10-year Treasury yield, it has collapsed to 161. It broke through that level as well. So something is happening right now that is dramatically impacting not just the yen-dollar exchange rate, but at the exact same time, the 10-year Treasury yield. These are highly unusual moves, almost unprecedented, huge red flags that tell us something big is happening beneath the surface. The question becomes, what is it? What on earth is going on that would lead to these moves that we are seeing in global markets? And maybe more importantly, how does this play out? What's the end game? And how could it impact you, the average person watching this video right now? Those are the questions I'm going to answer throughout the rest of this video. Step number 2. So what on earth is actually happening right now? Well, I'm going to go over 3 of the most probable scenarios. In step number 1, we talked about how the central planners were completely losing control of the yen. They don't want it to go above 160, which is exactly what we've seen it do. But let's go through the mechanism of what they would do to try to slow down the decline of the yen once it got to that crucial 160 mark. So we've got the Ministry of Finance right here in red. They've got a balance sheet, assets on the left, liabilities on the right. Some of their assets include, wouldn't you know it, 10-year treasuries that are denominated in dollars. That's right. So if they see the yen starting to get to this line in the sand, they start to get nervous. So what could they do? Well, they can take those dollar assets that are treasuries and sell them into the global marketplace. What do they receive in return? They receive dollars. Okay, well, that's not going to do them any good. So they have to take those dollars and sell those back into the global marketplace and buy yen. So let's think about what this does from a standpoint of supply, demand, and price. When they're taking those treasuries and selling them into the market, that is increasing the supply. Now let's assume that demand stays constant. That means the price would go down because supply relative to demand is going up. Then when they take those dollars, sell them into the global marketplace, they're increasing the supply of dollars, but they're buying yen with those dollars. So you're increasing the supply of dollars, but you're increasing the demand for yen, which would make the price of the yen relative to the dollar go up, at least in theory. On paper it works, but in practice, maybe not so much. Meaning in the short run, so over the span of a couple days, they might be able to engineer an appreciating yen. But after those few days, when we get into the weeks and months, then the yen just drops even faster, starts dropping like a stone again, because the marketplace understands this is all nonsense. This is just a complete ruse. And at the end of the day, the central planners in Japan are never going to be as powerful as the market. The next reason this could be happening is, let's remember, commodities are priced in dollars. And Japan is a huge importer of commodities such as oil. So let's think this through. If you're a mega corporation in Japan, here's your balance sheet. You've got assets on the left, liabilities on the right. You probably have treasuries as well as a good hedge because they're priced in dollars. But you're going to have a lot of yen. In this case, let's say they've got 10,000 yen as assets on their balance sheet, just their cash position. Okay, well, right now, the yen is losing value massively. And the central planners have come out and said, okay, well, they're going to defend the 160 mark. So initially, you believe them because you're not a student of economic history. You're probably buddies with a lot of the people at the Ministry of Finance. So you're saying to yourself, okay, those are pretty competent guys. I go out with Joe. We play 9 holes of golf every single weekend. And if he says he can defend the currency, well, sure enough, he can. But then what happens is once the yen breaks through that 160 mark, now all of a sudden, you're like, holy cow, maybe Joe isn't as smart as I thought he was. What happens if the yen goes to 200, 250, 300? These are the thoughts that are racing through your mind. Because if the yen devalues to that extent, how on earth are you going to buy the oil you need as an input to produce your widget, let's say? So when that line in the sand is breached, this could have triggered a huge selling moment for these megacorporations. A lot of them have traders that work for them full time, so they could have told these guys, listen, if it looks like there's no way they're going to be able to defend it at 160, then we need to go ahead and sell some of our dollar assets so we have the liquidity to go ahead and buy the commodities we need in the future, and we don't have to use yen. Well, why would they do this? Think about it. If they have 10,000 yen on their balance sheet right now, and let's just assume for the sake of the example, these are not exact numbers, not even close, but it helps you understand the concept, and that's what we're doing here. So let's assume that 10,000 yen back a couple weeks ago would buy 2 barrels of oil. Okay, but if they're looking into the future and saying, wow, Now that 10,000 yen will likely only buy 1 barrel of oil. We don't have enough yen to make that happen because we need those 2 barrels of oil. So we would prefer to take the 10,000 yen and allocate them to other things in the domestic economy that we have to pay for, such as payroll, because payroll isn't going up at the same rate relative to the yen that these commodities are, because their payroll isn't priced in dollars. So they make an executive decision to go ahead and sell a lot of those treasuries on their balance sheet because the treasuries that they have 2 weeks ago bought 2 barrels of oil, and today they also buy 2 barrels of oil. So the traders get the cues from the executive, they take the treasuries, sell them into the global marketplace, they get the dollars, take the dollars, go back into the commodity global marketplace, they buy the oil they need to go ahead and stockpile so they don't have to worry about this at least for the next 6 months. They're hedged because they have all the inputs they need to produce the widgets to make sure they can stay in business. Now, of course, this is suboptimal. They don't want to sell those treasuries. They'd much prefer to keep them on the balance sheet. But I think the other day, when that crossed 160 and 161, they knew definitively. I'm sure they thought about this well in advance and came to the conclusion that, hey, once we get to this point, then we need to go ahead and take action. And I think that's why once we saw the yen break above 160, 161, you could have seen that huge sell-off in treasuries. But I had a very interesting conversation with my good buddy Jeff Snyder over at Eurodollar University. He is one of the foremost experts on how these flows work with the treasuries, the global monetary system, the yen, the dollar, commodities, etc. And in his view, it's highly unlikely that it was the Ministry of Finance selling treasuries, and also unlikely that it was commodities or the fact that commodities are priced in dollars, and therefore these mega corporations, to hedge their bets, need to sell those treasuries to get dollars to stockpile commodities. His base case is that these unprecedented moves we're seeing in global markets right now is a result of systemically important financial institutions in Japan. In other words, banks. So let's go ahead and look at a balance sheet of a Japanese bank. And it's amazing how this changes. It's just like magic, isn't it? But again, they'll have assets on the left, liabilities on the right. This time, they have those treasuries and they have a yen cash position. But they also have a loan because they had to borrow the dollars in order to buy the treasuries to begin with, because treasuries are a dollar-denominated asset. So back in the good old days, when the Fed had interest rates at, let's say, 0%, this made a lot of sense because they could borrow at, let's say, 1%. And let's assume for a moment they're borrowing $1 million. Again, these aren't exact numbers. We're just using them for the example. So they borrow $1 million at 1%. They buy treasuries that are yielding 3%. So they're pocketing the spread of 2%. Well, that works all day long. Very low risk, unless interest rates go up. So what happens is when the Fed takes interest rates up, the yield on, let's just say, these 10-year treasuries go from 3% up to 5%. So now they still have $1 million worth of treasuries at 3%, but the value in the marketplace has plummeted because there's an inverse relationship between the yield and the price. So if the yield goes up, then the price goes down. But while the price is going down with the assets they're holding on to, their funding costs are not staying at 1%. Because remember, the Fed is raising those short-term rates that impact how much they have to pay for those dollars to begin with. So let's assume they're rolling over this debt every month to buy these 10-year treasuries. That's how banks make money. They borrow short-term, they lend long-term at a higher interest rate. But their funding costs go from 1% up to 5%, for the sake of this example. Well, you can see that they're paying 5% to make 3%. And that dog don't hunt. They have a negative carry. They're hemorrhaging money every single month. So even though they're going to take a huge loss by selling these treasuries, they don't have a choice. They have to, because they have to replace them with another asset on their balance sheet that's going to yield more than the price they're paying to borrow the dollars to begin with. More on that in just a moment. So going back to the predicament that J Bank is in, they have to sell those treasuries into the global marketplace. But let's remember, although they paid $1 million for these treasuries, and they would receive the $1 million if they held them to maturity, they can't hold them to maturity. They're forced to sell them because of the negative carry. So the global marketplace pays them $900,000, a lower price. But wait a minute, they owe $1 million. It's not like how much they owe went down. It's just the value of what they bought went down. So if they're receiving $900,000, but they've got to pay off this debt that's maturing, that's $1 million, well, there's a $100,000 discrepancy. So where do they get the 100 grand? Well, they have to go to their balance sheet, say, well, the only thing we have left are yen. But the person that we borrowed the dollars from, they're not going to accept yen. So they have to take these yen and go right back out into the global marketplace and sell them for dollars. Well, what does that do to the value of the yen? Because we're increasing the supply of yen, we're increasing the demand for dollars, which makes the dollar price relative to the yen go up. In other words, it makes the price of the yen go down, maybe to 160, 161, or even lower. Whoa, time out. Once again, I want to remind everyone that as the number of yen to buy $1 is going up, that's actually an indication that the value of the yen is going down. It gets a little weird there, but let's take it to an extreme. If the number of yen required to buy $1 went to 1,000, well, the value, you can see very quickly, of yen would be going down. It would be absolutely plummeting. And if the number of yen to buy $1 went to, let's say, 1, well, then it would be appreciating in value relative to where it is today at 160 or 161, although the number on the chart is going down. So remember, if the number of yen to buy $1 is going up, that means it's losing value. If the number of yen to buy $1 is going down, that means it's gaining value. Now it's very clear to see why Jeff Snyder's base case is what's most likely causing these extreme moves that we're seeing with the 10-year Treasury and the Japanese yen relative to the dollar. But unfortunately, this isn't where the story ends. Because remember, like I was saying earlier, the Japanese banks, the systemically important financial institutions, have to sell those treasuries, but they have to buy something else to put on their balance sheet that will give them a much higher yield than the dollars they're borrowing. If they have to go out there and find an asset to buy that's going to produce a much higher yield, well, you guys know where we're going with this. They're also going to have to find an asset to buy that has much, much higher risk. Step number 3. So how does this play out? What's the end game? Well, at the beginning of this video, I talked about how I think we will go into a deflation-inflation doom loop. Let me explain what I'm referring to. In step number 1 and step number 2, we talked about how investors are dumping yen assets for obvious reasons when you look at their economy and the fragility of their banking system. So it puts downward pressure on the yen versus the dollar, but all those commodities that they're importing are denominated in dollars. So this puts upward pressure temporarily on consumer prices in Japan. Now, it can also lead to disinflation and outright deflation. It's very counterintuitive. Let me explain. Assume for a moment that you're making $1,000 a month. That's your paycheck. And currently, $500 of the 1,000 is going to pay for commodities. So that would just be your energy bill, let's say, or putting gas in the car. All right, well, you have another $500 to spend at Walmart, Target, Home Depot. Okay, but what if the price of the energy, the commodities that you have to buy every single month go up to $1,000? Now all of a sudden you have zero to spend at Walmart, Target, Home Depot. So it's this inflationary deflation where the prices of the stuff you need that you have to have are going up. Therefore, the prices of the stuff you want are going down. So all those businesses that sell the stuff you want are now having to lay off or fire employees. That makes the unemployment rate go up, which takes you straight into a recession. Well, in a recession, whether it's inflationary, disinflationary, or deflationary, what usually happens to asset prices? Well, that's where we usually have asset price deflation. A fantastic example would, of course, be the GFC. Now, during the GFC, home prices plummeted in value, while at the same time, consumer prices actually went up for the most part. We did have a quarter of deflation in 2009, but if you look at the peak of home prices in 2006 and then the bottom in 2012, consumer prices went up, in fact, way up, compounded during that time frame. Another great example would be the 1970s. In the early 70s, we had extreme consumer price inflation, yet the stock market went down by 50% in the bear market of 1974. But before we go any further, let's remember what we were talking about at the end of step number 2. Remember the CLOs, the Japanese banks, the systemically important or systemically risky financial institutions. Remember, they've got to sell those treasuries because they've got that negative carry. And they need something on their balance sheet that is going to pay them a higher interest rate. So they've got to take way more risk. So they're selling treasuries and, believe it or not, buying derivatives. What Warren Buffett calls the financial weapons of mass destruction. So they're taking all of these CLO derivatives and putting them on their balance sheet. What's the underlying asset? Well, it's junk corporate debt and, drum roll please, commercial real estate. Everybody's favorite asset class that is absolutely plummeting in value. So what happens if we go into a recession right here in the United States? Well, all those risky corporations aren't going to be able to pay back their debt, and the commercial real estate market is going to go down even farther. Well, if that happens, the value of those CLOs that all these Japanese banks are now forced to buy, the value of those CLOs is going to plummet, if not go all the way down to zero. Well, that blows a hole in the balance sheet of these financial institutions, and that's if they're able to survive. Many of them will likely go bust. Well, if your financial institutions, banks, are going bust, what does that do for the local economy? And what does that do for local asset prices? It's an easy question to answer, and the response mechanism from the central planners would be just as obvious. So let's get a visual here with this deflation, inflation doom loop. The yen goes down, this creates consumer price inflation in Japan because of those commodity prices, but that only lasts so long because you're robbing Peter to pay Paul. Therefore, we go straight into a recession, even if it is an inflationary recession, which leads to deflation in asset prices. Well, this makes the whole system, the whole house of cards, come crashing down, which brings in the central planners to do something. Well, whatever it is they do is going to lead to further economic distortions that will put more downward pressure on the yen versus the dollar and take us straight back into this doom loop. I think it's very crucial to point out, from 1980 to 2020, we saw interest rates overall decline. Usually this happens in 30 or 40-year cycles. Well, during this time, we saw inflation go down for the most part, and asset prices go up. Well, if we have the opposite happen, where interest rates, that cycle reverses. And over the next 40 years, instead of interest rates going down, they continue to go up. Now, they're not going to go up in a straight line. It's going to be a roller coaster ride, But assuming the trend is up, like we saw the trend going down from 1980 to 2020, well, then you should also assume the rates of inflation or the trends in inflation and asset prices will also reverse. So if rates are going down for 40 years and we have inflation going down, assets going up, if interest rates go up for 40 years, we should expect to see inflation go up while asset prices go down. Again, the deflation, inflation, doom loop. Let me be very clear. What I'm talking about here are simply risks in the system that the mainstream media never, ever talks about. There are no certainties, there are only probabilities. But when you're analyzing what the future might look like, and therefore how to set up your portfolio, you need to be as informed as possible. I always say that burying your head in the sand like an ostrich is a very poor investment strategy. And understanding this stuff, although it's not a prediction, but understanding these risks that you never hear about in the mainstream media gives you a huge edge over the other retail investors. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.